Good evening and welcome to the October edition of our E.M.I program, which will focus on our outlook on the economy, markets, and what one should do with one's investments. Right. This time, I'm going to spend, well, as usual, a little time on the world economy and Indian economy, but my greater focus is going to be touching on the markets, valuations, and what should an investor do from the way forward. What's the outlook for the Indian economy from a medium term perspective, which I'd like to present our vision of the same. So I'll spend a little more time on that, right? So let me commence it by just giving you a summary of the world economy. The good news from a pure economy front is that no, the world economy is, like as I said here, riding the recovery, but more importantly, that it's a very synchronous recovery. So this data from the IMF here, and if you look at it from a growth perspective, I draw your attention to the extreme right of this table, where we have given the growth rates for 2020, the pandemic affected year, 2021, the recovery year, and 2022, which is hopefully a more normal year. So as you can see from a negative 3.2, the world is going to post this year 6.3. Now that may look very good, but remember that 6.3 is on the back because these data are all year on year. So they are, because previous year was down, so effectively you are dividing by 96.8 instead of 100. So these numbers looks much better because of that. So the next year, when you have a base of 106.3, to show a 4.5% growth is very good. So first, the world is back on a growth path. But as you can go down the table, you'll see that most regions, countries are all showing the same level of growth uptick. So it's a synchronous recovery, which is very different from what happened during the global financial crisis, when there was a partial recovery by some regions, then the other regions followed. Good news. The other good news is, of course, is that India, both in this bounce back year as well as in the next more normal year, is going to be the fastest growing region of the world, right? So this synchronous recovery is also because of the fact that while the developed markets, because Pfizer, Moderna, all these Johnson and Johnson, all these companies are essentially developed market countries, right? Regardless of where the vaccines were produced, over the last month, there has been a strong improvement in the emerging market rate. And so the global average has moved up just under 50% for this, based on the fact that the Asian average has gone up to 54 from 44, which again augurs well for a synchronous recovery, because developed markets can't grow without supply coming from the emerging economies. Remember that. So both have to go hand in hand, right? So that has contributed to this. And the result of that is actually seen in what is probably the best inter-country trade-related indicator, which is called the Baltic Dry Index, which is nothing but the shipping freight rates, right? Which is a purely demand-supply situation. So pre-pandemic, the world as it was, this December 21, 2019, this level was at 1090. The pandemic brought a 40% correction to 626 in March. But can you see since then, it's multiplied almost 7 times. So I think this one particular indicator itself tells you that a global synchronous recovery is already underway. Now, this global recovery, while it's all good news from an economic front, is not necessarily good news from a stock market front. Why is that? Because when there is a recovery, what happens in a developed market scenario, because the liquidity starts from the developed market to the emerging market, stock markets, that liquidity is because the globe was not doing well, right? The advanced countries are not doing well. But as we see this recovery happen, right, what will happen is they are demand-driven economies. So when demand starts exceeding supply, you have inflationary pressures coming up, and with those growth coming, more liquidity being fueled would fuel the inflation even higher and lead to tremendous hyperinflation. So the Fed has to keep track of the global growth and tone it down whenever the growth is appearing very strong, right? So this strength in the advanced economies means that tapering will happen. Now, when tapering will happen is a function of what the Fed feels, because already inflation has started rising. But as you were aware, they felt this inflation was temporary. One. Two, that inflation was driven on the supply side, which is prices of metals increasing prices. So those two are not necessarily something that's a cause for worry. It's the demand side inflation and the consequent permanent inflation increase, which is the worry for the Fed. Now, they had earlier indicated that they expected that to happen, a demand side strong recovery by the end of this year, and hence said that tapering will happen then. Luckily for the markets, there's a fourth wave of infections which is just about coming. And so the Fed has kind of dragged its feet and said we'll push this taper to 22 early. So to that extent, the markets have got a breather. But remember, it's a matter of when and not if. Sooner or later, the taper will have to happen with its consequent impact, which we will come to in a bit. But the second thing is that normally they withdraw the liquidity and they also hike the rates because inflation is the main concern from an interest rate rise perspective. That will cool down inflation because it will cool down demand. But this time the Fed, very conscious that they don't want to create a shock impact on the market, have said that they will be delinking the taper from the rate hike. So while taper may happen early 22, they are saying the rate hikes will happen only 2023. To that extent, any impact of the tapering will be moderated because there's no accompanying rate hike coming into effect. So that's an important point. How does this rate hike affect the liquidity to the markets? Because hedge funds borrow from banks and other companies there and leverage that money and put it into the emerging market stock markets like India. So if rate hike is not going to come up, there is no fear that that hedge fund money will roll back and go away. So that in that sense, we'll have to keep tracking the US growth in a very strong way. The other thing that this rate hike pushing to 2023 does for India specifically is that it gives RBI much more breathing space, because RBI, if US raises rates, RBI will have to follow suit, otherwise the currency will bear the impact of the difference in the rates. I'll just show a slide on that. But because the rate hikes have been pushed to 2023, it gives RBI the power to continue with their accommodative stance on the interest rate front for one more year. So that's good news as far as the Indian economy is concerned. So other than the fourth wave, Fed has also got to look at the risks from the recent oil price spike, right? So the commodity space is also something Fed will take into account. But that being said, global growth appears to be on a solid footing. The only risk being that there's a supply side shortfall, as you're aware, in the semiconductor space and many other spaces. That normalization, could delay the growth recovery of the world. So when that quickly comes back, we will expect much more normal, right? But that apart, we feel that taper is not that much of a bugbear for some of the reasons laid out here, but for a more important reason, which I will focus with India in perspective, right? It's generally true of the emerging markets also. So what is this? I want to analyze the taper impact when it happens on India. For that, it's important that this time compared to 2013, the taper caused the rupee to go from 48 to 72. And Mr. Raghuram Rajan had to go around with a begging bowl guaranteeing a 4% dollar return to NRIs and raise $35 billion to protect us from that, right? This time around, our forex reserves, India, apart from China, has been the biggest forex reserve addition since the pandemic, right? You can see that table. This forex reserve addition, which was $164 billion in this period, what RBI did with it is important. So RBI used that to add to their reserves and allowed the rupee to weaken. If they had used these dollars to fight the rupee and keep the rupee stronger, then our reserves would not have gone up. So RBI should be complimented on a very, very foresightful strategy that they allowed the rupee to weaken. How much? I'll just show you, right? And so today at forex reserves of 640 billion, we have 14 months of import cover. So there's no need to worry that India's high import bill will get affected and hence the currency need not react. Whereas in 2013, we had only a month's forex cover. That's why Mr. Rajan had to take that drastic step, right? And also remember that along with this, the government has also been extra careful and stayed away from giving away money. So their fiscal deficit has been kept in check. Whatever they have spent, they're spending it on the capex front, which we'll deal with in later detail, right? So a contained fiscal deficit, marginal current account deficit because of these trade exports going up has kept taper fears well at bay for India. Now I spoke about rupee depreciation. So what the RBI has done So if you take over the last 1 year, right, they have allowed the rupee to weaken by 2%, right? So that is what has helped them to accumulate their forex reserves, right? Now, is there room for a further depreciation if need be to continue to maintain this good forex reserve stance? Absolutely, because RBI can afford to allow the rupee to weaken even more, because if you look at the way currency behaves, it's essentially the difference in interest rates between the two risk-free rates, which is the government of India and government of US borrowing rates. I've tracked this here for October 25, March 2019, December 2019, September 2019, just to show you the trend over a longer period, that by and large, the differential between the two interest rates is hovering between 4.75 to 5.5%, which means that the longer term depreciation of the rupee should be around these levels. So if you go down the chart to the table, you will see that the 10-year USD INR change percentage is 4.9%. So RBI can allow the rupee to depreciate by as much as 5% and allow their forex reserve to get accumulated without any fear. So I think this summarizes the fact that RBI has enough ammunition to counter a tapering. The story for the emerging markets is reasonably similar, so India is in a slightly more favorable position because we've got more FDI and more FII flows than the other countries, which you will see in later slides, right? So now, having covered the world and the tapering impact, let's focus on the Indian economy. And the story for India is also that we are also riding a recovery wave, right? But first, let's look at the COVID impact, because that's what is dominating our mind share and what has COVID done to our economic numbers, and that we will see. So first is that the second wave saw a spike, as you can see, in both the daily infections and in the number of deaths, right? These are the 7-day moving averages. But as you can see, we have covered that hump, and now the situation has flattened. The curve has flattened. Both the infection curve and mortality curve have flattened out. So which means that the negative impact of the second wave has been passed, and we are now pretty much back to normal. If and only a third wave comes up strongly, do we need to worry, right? So based on this, what are the short frequency trackers of the economy telling us? So first is you will rely on the mobility indicators of Google, because they are the best reflector of general economic activity. So whether it's in recreation, parks, workplace, groceries, pharmacies, transit, anywhere you see, there was an impact of the second wave in the dip, but you have seen either a V or a U-shaped recovery happening in more of these. That means life is fast trending back to normal. The second indicator you would like to actually observe is the PMI, because there is more correlation to the corporate world. And there, when you see, right, second wave you saw, first wave, of course, a big contraction. The second wave saw below 50 means contraction, above 50 means expansion. The trend line is also important. So if you see after the second wave, which dropped below 50 for both the manufacturing and services, you're now seeing a V-shaped recovery, which means that A, the trend line is trending upwards, as well as the fact that they are above 50. So clearly the Indian economy has come back into an expansion mode from a contracting mode, right? The other indicator that's important to track is the unemployment rate, which directly reflects probably some amount of the manufacturing and services PMI. There, when you can see, right, there was a spike in unemployment in the second wave. Of course, the first wave was massive. And then you've seen that it's plateaued out and more or less stabilized. So you are seeing that unemployment rate is also stabilized, which is a good news for the economy. The third angle that we must look at is what's the government's business doing. The government does most of its business through e-way bills, starting from the last few years. And there you can see also the impact of the second wave has been now countered, and a sharp V-shaped recovery in e-way bills is underway. So overall, if you want to summarize these through some indicators, you will look at it from a Nomura index of business consumption. What they've done is they've placed the pre-pandemic level at 100 and tracked how the various fragments of the economy have been doing. Obviously, in the first wave, it dropped to 45. The recovery from the first wave saw it go all the way to 96. But the second wave came and hit it back to 60. But now, as you see in the bounce back, we have not only reached the 100 mark, which is pre-COVID, but we have gone to 108.8, which is almost 9% higher than the pre-COVID levels. So this is again a strong reinforcement of the fact that the economy is now getting on a very good wicket, right? Now, in addition to these economy's numbers, it's important to maintain the fiscal deficit situation and look at that. because ultimately that affects the amount of foreign flows, India's rating, and all of that. So there, if you can see, the good news is that the first 5 months of the current fiscal has witnessed a sharp increase in fiscal revenue by the center, and it's a clear reflection of the pickup in economic activity and business assumption, and by a smaller proportion to the states, which you can see in this slide, the 20 states fiscal position. So clearly, you are seeing that both center and state are seeing an increase in revenues, which is a good news from a fiscal deficit perspective, right? So to summarize, the short-term outlook of the economy going forward is a third wave risk, which has to be countered only by the vaccination trend. So as of 18th October, India has vaccinated 77% of its adult population, which is 51% of the total population, and for one dose, and 32% for both doses. So clearly, the by and large the population is in a much better prepared status to counter, because as you know, vaccination doesn't say that you will not get COVID. All it says is that COVID's impact will be very less severe. The likelihood of hospitalization will be less. The likelihood of you dying from COVID will be very less. So, which means that people after a 2 weeks or 3 weeks break, even if they get COVID, can get back to work and normal life. So, I think this is a big difference between the first wave and the second wave. But a third wave has got a large proportion of India's population, working population, vaccinated and got some kind of a protection. So what is the way forward? What is the outlook? If the current rate of vaccination continues, we expect that by somewhere by end of March, right, we should be achieving 100% adult population coverage, which is very good. But the government has activated a lot more vaccines, allowed import of vaccines. So we hope that if they are able to double the rate, we could actually see that by end November itself, they could achieve the 100%. Might seem optimistic, but the reality will probably lie somewhere in between. So which means that if you're talking about, say, December, January, then a third wave coming due to the festival season. As you know, Kerala saw a strong spike during the Onam festivities. The same thing around Diwali is a risk for India. But this vaccination rates, right, are the ones which are our defense against that. So this progress on the vaccination front, I think, augurs very well for muting the third wave, if any, impact on the economy perspective, right? So as a result, the GDP growth, if you look at it, the blue V shape tells you the trajectory that we currently foresee. But the yellow actually is interesting, because yellow was the projected India's GDP growth pre-pandemic. When without the pandemic hitting us, we had expected to India to grow along these lines. So the interesting thing is, in this second quarter, you have seen that the growth trajectory path has exceeded what we expected pre-COVID. So the strength of the Indian economic recovery is clearly apparent to you all, right? So to summarize the points that I've just spoken, I've just written it down here. You can just quickly go through it. I'm not going to read it all over again, but essentially this is what I've said, right? And the short frequency indicators also I showed you. So we expect agri, government spending and exports, which are above pre-COVID levels, and the festive season to support it. And I think exports is really going up very well. And if the global commodity space remains conducive, an extra layer to the India story. Private capex announcements started now. We'll cover that in a little bit more detail a bit later, right? And inflation also is likely to be contained, because with the food crop coming through of the next, in December, January, we think food inflation, which is a big part of the core inflation, will keep the soft stance and help RBI to maintain their pro-growth stance. So based on this short-term outlook of the economy, let's look at what's happening in the markets, right? Now in the markets, the story is that for the last 3 years, FIIs have been supporting us with massive flows, 14 billion, 23 billion, and 8.5 billion in the first few months of the current year. And the good news is that this has been something that every quarter has been consistent, barring a few quarters, either due to second wave or to certain other impacts. So the steady flow of FIIs indicates that they are looking at India positively, so much so that if you compare within the emerging market pack, leaving out China, of course, it's only Indonesia and India, which whether you take as week to date, month to date, quarter, calendar, financial year to date, have been consistently getting positive flows from FIIs. Now, why are these FIIs giving positive flows to India? Indonesia has a different reason, we'll not look at that, is that the projection for the Nifty's EPS from a 542 for the current year, FY21, right, there is a year gone by, we are expecting an 865 EPS. So if you plot that as a percentage, it shows a 26% CAGR. This strong growth expected in the large cap space is what is driving. And here again, these numbers have been borne out if you take a quarterly EPS growth of Nifty, both including financials and without. As you can see there, the second wave gave it a bit of a chanka, but after that, you can see the sharp spike right from the June quarter, that the quarterly PAT growth of Nifty has spiked up, thereby justifying the optimism behind those projections that have been put there, right? So this is the main reason that we've been getting money consistently. And for this year, if you see the FIS who put in money over the last year, what has been their experience? Now, half of the markets in the world have delivered negative returns. Half have given positive returns, and India features right in the middle of that pack of positive returns with 26% return for the year. So obviously, FIIs this year are in a very happy space. Having chosen India as a favorite to invest in, they have had a very good past record. In fact, not just this calendar year to date, if you look at it since the pandemic, right? And I've got developed market index here, I've got emerging market index here, I've got the American index here, I've got emerging market only Asia here. All of those regions, if you look at the black line going through the middle, right? As of September end, India was the best performing market since the pandemic. So all the money flow we have got since the pandemic has justified, right, through the returns to the FIIs. So one important thing from a tapering perspective, remember, is that the FIIs have had a very pleasant and positive experience of investing in India. And hence, to that extent, their likelihood of reversal will get tempered down because you don't necessarily exit your best performing and the best returns to your market, right? So now we move to the fact on broader market, you need domestic flows, and we all know the story behind retail inflows. Apart from that, mutual funds, which during the pandemic year last year, right, calendar year last year, pulled out 56,000 crores because investors were also panicking, and mutual funds was also not very confident about the fact that the first wave hit us very badly, second wave came out. So they were very cautious, and hence they had a net negative. But this year, they've changed it to 16,000 crores positive, 159 billion, right? But this is may not look a big number, but look at it in terms of the financial year, because I think that's the calendar year data. So in the financial year, so if you look at the top line, that gives you the 4 quarters of the previous financial year. So there when you see MFs in quarter 1 of last year, that is, sorry, quarter 1, 21, that is January, February, March, also pulled out 28,000 crores. Right? And here from quarter 2, if you go down to the below table, mutual funds have brought in 13,000 crores in the first quarter of the calendar financial year and 45,000 crores in the next July, August, September. This quarter, you're seeing some profit booking, both from FIIs and from us. So there has been some little bit of they take money taken, but still financial year to date, mutual funds have pumped in 56,000 crores as opposed to 3,500 crores of FIIs. So clearly the leadership in terms of the stock market for April to now has passed on to the domestic investors, right? And they are driving the flows. So from that point of view, let's now look at the 3 indices: large cap, mid cap, small cap. Now there are 2 ways of looking at this graph, right? And many of you know the data. So one is to look at it from a post-pandemic, right? March 20. Can you see in the middle? March 20. And there when you see the rise, you will realize that the small caps have written the best, followed by the mid caps, followed by the large caps, right? If you purely at point to point, and that's what the data is telling you. And so a lot of people are getting concerned saying mid caps, are they overvalued? Small caps, are they overvalued? What should we do? But just put it back in time to December 2017, which was the previous market peak. Because Indian economy, right from then, had been on a slowdown, even pre-pandemic. So mid and small cap got more deeply affected than large caps in the period between December 17 to March 20. It is that fall which has got set right now. So overall, if you now look at the numbers from December 2017 to now, you'll see that still large caps are the best performing index with 76%, mid caps follow with 56, and small cap has returned only 29. So to pictures from the same graph, right? Even from a pure pandemic perspective, small caps may look to outperform. But when you look at it from an overall longer term Indian economy perspective, the fact is that small caps are the underperforming segment, followed by mid cap and then the large caps. So why is this happening? Please remember that small and mid caps are more closely tuned to the domestic economy's performance, whereas large caps partly to domestic economy, but partly to foreign money coming in, which is largely in the large cap and the larger mid cap space. So that's the way you should analyze and look at this. And so if the Indian economy's outlook is going to look good, then mid and small caps are still a good bet from a valuation perspective. Right? That being said, right, purely looking at the cap curve is not going to be helpful because this is a net result of the actions of FII fund managers, domestic MF fund managers, insurance fund managers. How do they invest? They don't look at the cap curve and invest, they look at the sectors and invest. So that's the important next point I want to drive, that right from 2007 to now, 14 years, right? Each year, if you look, the sectoral performance of the sectoral indices, right, has been wildly varying. Year on year, the leadership changes hands. So dynamically managing this sectoral mix is what then leads to either large cap, mid cap or small cap outperforming and the consequent alpha generation. So what I wanted to drive at is, if you now look at it then, the post-pandemic period, 2020, right? What was the best performing? IT, healthcare, safety-oriented sectors dominated in a bad economic time frame. But when you now look at the fact of first half, what's happened? The leadership has changed to whom? To metals, to IT continues, to power, to realty, and to capital goods, the ones in green. And I'll draw your attention to 2007 now, which was the 2007, 3 to 7 boom period. What are the best performing sectors? Capital goods, metals, oil and gas. So can you see that the story is beginning to repeat? As the economy's, domestic economy's performance improves, these are the domestic economy sensitive sectors which take the leadership. So please bear in mind that the other thing to talk about small and mid caps is look at which sectors dominate those indices, because then that sectoral performance will affect that index in a better way. And this is what I've shown here in terms of the returns. So if you take the 1 month return versus the 3-year returns, you can see that 1 month return, that which is negative, IT, tech, healthcare, 3-year return is the best performing. So you can't just take those 3-year returns and say, I will make my investment decision, right? You got to look at it from an economy perspective. In fact, if you want to look at it on a pre-COVID, post-COVID, this graph tells you, then I've ranked the performances, right? So the best performing sector in a COVID impact, right, which is everything was negative, but was FMCG, right? Followed by what is that? Consumer, right? So these are the safety oriented things which cushion the fall, and the worst performing sectors were realty and oil and gas and bankex and all of those. But just take a look at the middle ranking, which is a V-shaped recovery, that is from March 31, 20 to October 25th now. Who can you see what are the best performing sector? It's the metals, followed by realty, followed by power. So the cyclical sectors again have dominated the recovery. So please bear in mind that sectoral allocation appropriation is more important than just looking at cap curves. With that, let's just finally look at what I consider as what the risks the market is tracking to for the FIIs to decide on India versus non-India, on within India, the sectors which to prefer. So you can see the bubble size tells you the size of the risk. So US is the biggest tracker for all investors in the market, followed closely by the Fed and by global trade on how that's going, and by commodity spike, right? China is a concern more from a global risk perspective rather than anything else. So from these are the ones that you should be tracking, and the market will also track to determine the direction of the market in the short term, right? So I've given you a good bit of data on the short term and showed you how the market is reacting to that data of the immediate short term. But bear in mind that investors are not just investing only for the short term. There are investors who invest for the short term, but for the medium term investors, and there are FIIs who are doing long-term investing, who are still buying in the current correction. And if you track them and why they are doing what they do, then our investment decisions from a 3 to 5 year perspective will also make much more sense. So I'm now going to shift into the medium term outlook for the Indian economy and a peek into the future. So what I want to drive at is India's flows from the FIIs. Not every FII is looking at short-term gains, right? Pension funds, sovereign wealth funds, right? All of these are looking at a longer-term perspective, and part of the money that's been coming in is with this outlook in mind. And that's important to understand what they are seeing. So what they are seeing is something that I'd like to call as the haptic effect. So what it means is essentially talking about the fact that 6 economic cycles are falling into place in India, right? So what does this haptic? It means that we are again hinting at a repeat of the 2003 to 10, then India's macro went sharply upwards, right? So what are these 6 cycles that are going to come and help do this? H for haptic, A for asset quality, P for corporate profitability, D for deleveraging, which is reduction of debt, and I for the interest rate cycle, and C for the corporate capex cycle, right? So let's look at this haptic. I first present to you a summary of what's happening, then I will take you through detail. But first, to understand this whole cyclicality, I want to tell you how cyclicality goes through various phases, right? So first is there's a rising cyclicality phase whenever in point in time. Once the rise happens to significant, it goes into a maturing phase, right? After the maturity is when suddenly you will find that supply exceeds demand, and hence prices come down and the decline phase happens. The decline goes down to finally a level where there is a bottoming out phase, and then automatically the capex comes in, the demand supply situation gets rectified, we go back into rising. So this is a cycle that these cyclicals follow. And if you now look at the first quarter 20, which is the red dots, right? In first quarter 20, the pandemic quarter, corporate capex, leveraging, profitability, housing were all in a bottoming stage. Only the interest rates, because they're falling, were in a rising thing, and asset quality had started improving even then. Now look at the green dots, which tells you what's the situation now, right? Fourth quarter 21. Is that only corporate leveraging is still in a bottoming phase. Corporate capex is at the capex, is the whatever you call cusp of change. Corporate profitability and housing have put into rising. Asset quality has improved so much that it's already in a maturing, and interest rates are probably at the end of the decline of interest rates, and we are probably going to start seeing rise in interest rates. So that gives you a summary, a snapshot, and the reasons for our statement on what is happening in fourth quarter 21 are summarized here. So in the housing cycle, after a 7-year down, 221 has seen an upturn in housing. On asset quality, gross NPL ratios have dropped by 5% from March 2018, right? So clearly strong improvement in the NPL, provision costs hence dropped, and credit growth is at the bottom, which means ideal situation for an upcycle. On the profitability piece, after posting meager corporate profit percentage of 0.4% over the last few years, stock market companies, stock market earnings from FY20 to 22, because FY20 was bad year, pandemic affected, now is set to be 51% growth, and the next 3-year period, which is FY22 to 24, will be likely to see a 15% EPS growth per annum. So naturally, the stock market will be expected to reflect that in terms of the stock prices. Then we come to the deleveraging. Deleveraging, nothing but paying down debt. Now, what has happened is over the last 6 years, since the economy has been in a downturn, corporates whose cash flows, because capacity utilization is dropping, they have not been spending that money. And the option in front of them to keep some amount in mutual funds or bank deposits versus they have used this money to pay down the debt they already took because it was probably very expensive. So today, from a 0.7x 6 years ago, sorry, 1x 6 years ago, overall debt equity ratio of the stock market is down to 0.7. It means it's a 30% improvement. What does this mean? It means that the credit rating of many companies has grown much better because of lower debt. And so when they want to spend on fresh capacity utilization, they have enough room on their balance sheet to borrow from banks and finance their growth. And with their credit rating being very good, their rates that they get for those borrowings will also be very competitive. So that's the deleveraging cycle. On the interest rate cycle, yes, interest rates have bottomed out, right? They're unlikely to go lower, right? But when they go higher, because corporate credit as it picks up demand will pull those rates higher, there will still not be a point of concern, because as long as the rate rises follow the growth. And if you see 2003 to 10, the same story was there. As corporate credit was rising, as the economy was improving, rates also rose. Because the key point is, if demand is exceeding supply, any rate hike cost can be passed on to the consumer. So I think this, while interest rates have bottomed out, is not necessary to worry that it can derail our growth, right? And corporate capex cycle, right? That's where it's at a complete down. Capital formation is down 7% from the 2012 peak. But what's the news on the ground? Infrastructure capex of the government is on the rise. I'm showing you slides on that. And the property cycle is, so the housing cycles you see on the top line will also help improve the risk cycle. So our expectation is that over the next 12 to 18 months, you will see a strong capex cycle. So now I have detailed slides on each of these. I shall quickly skim through those, but the key points I've already made here to go through. First is the housing cycle. What's in the housing cycle? The first thing, it's at a bottom. The residential sales, if you take top 7 cities, has underperformed since 2012 and is currently at a bottom. And so 2021 is showing an uptick, and we expect that from a 4% CAGR over the last 13 years, we should see an 8% plus CAGR over the next 4 years, right? Well beating the GDP growth rate expected, number one. Number two, residential sales have started picking up, the jump in volumes. So by FY23, which is the next year, we think it will reach multi-year highs. What is the evidence for this? Because existing unsold flats, residential inventories, are at an 8-year low now. We've taken the top 7 cities again to show you. So the existing stock is beginning to get liquidated, and so there won't soon be any built up flats to ready to sell available, right? And homes, pan India new launches and new sales of those new launches both have shown a sharp V-shaped recovery. Can you see? Because the real estate market also, thanks to RERA, has got regulated. There's been consolidation because the larger property companies have been buying out the very small ones, and the new breed of developers are very efficient at financing and turning around their projects. So this V-shaped recovery, right, is also being seen in terms of a gentle rise in property prices, right, after a fall. So we expect this to get sustained. Again, it's a demand supply story, right? And what is driving all of this is that the low interest rate plus property prices having stabilized, plus incomes also not getting affected in the pandemic. All three factors put together mean that today you are at the best ever affordability level last seen in 2003. So that's another reason we say that 2003 to 8 wala cycle is going to get repeated, because today a person's income, you need only 28% from the E.M.I to go and buy a house, right? So as a result, home loan penetration at 12% of GDP has plenty of headroom to go up in the coming years. We expect strong governmental support also for this segment because of two things: the government's promise of other housing, affordability housing, but more importantly, the real estate sector is probably the biggest employment generator. And as the election approaches nearby, next year is a big UP election, but 24 we are having the India election. So you will see that employment will be on top of the agenda. Hence, the government will do everything to create an employment story, which is where the real estate housing sector fits in brilliantly, right? Let's move to the asset quality cycle that we spoke about, right? Now, when you see the big banks and you look at the fact of their provisioning, you will see that when you take the restructuring, slippages, and excess provisions and the additional provision required, they still have balance. Only Federal Bank has drawn down on its provision buffer and is negative. All the banks have enough provision for any negative surprises in the coming months. So they have over provided, which is both in terms of COVID provisionings and in terms of overall NPL provisioning, right? On top of it, debit bounce rate. Debit bounce is a complicated word. It's actually check bounce, right? So if you look at it there, the volume and the value, both after peaking in September 20, have come down sharply. right? So if you then look, because the first one is how much is down, and second one is the average for that period pre-COVID. So we are fast approaching the pre-COVID level in terms of debit bounces, right? Which is a very good news in terms of generally the bank's performance, right? So to summarize, right, with the pickup in activity, a few banks have to dip into their COVID provisions as they realized they had over provision for uncertainty. Second, key systemic banks continue to have excess provisions despite this, even after accounting for this. And third is debit bounce rates have peaked and they are way to pre-COVID levels. So overall, from an asset quality perspective, the banking system is in a much healthier space to finance the requirement for the economic recovery from their balance sheet, right? So that's where when you see the bad asset cycle is now in a reversal mode, because the insolvency laws, most recent being the DHFL thing which got resolved in some way, is the biggest development, and this will also help banks to clean up their existing cycle of bad assets, right? And bad loan provisioning has also peaked at 69% of bad loans. Current provisioning is more than adequate, right? And banks have also been smart in this period to support their future lending, which they are expecting a pickup, to improve their capital adequacy by raising funds at the right time. So you see, all of the banks have got much higher than pre-COVID levels, tier 1 capital adequacy, which means their ability to lend now gets much, much better, right? So that was a summary of the NPL cycle, asset quality. And now we move to corporate profitability. On corporate profits, right? Yes, it's at the bottom, because 2003 to 10, that decade saw a sharp rise in profits. 10 to 20 saw a sharp fall, but in 21, you're already seeing an actual rise and then a projected rise. So I think this cycle of the corporate profitability is at the right stage to take off and show a similar trajectory what we saw in 2000 to 2010 decade, right? And if you look at what contributed to this, right, this quarter and this financial year, it's the banking and financial stocks and metals that have driven. But there are a host of other sectors which in the coming quarters will take up a larger proportion of the upturn in profitability, right? And the result of the debt reduction and all of that means that ROEs, return on equity, has again started to do a V-shaped recovery. Why is this very important? Because ROEs we expect by this 21-22 itself will hit 12.5%. What's the importance of this? Because when the existing business, the return on equity is showing double-digit returns, then the temptation for a corporate to put that money into mutual funds or to bank deposits, right, is going to be very less, because their business can generate higher returns, number one. Then what will they do in investing in their business? The only way to go is to do capex. And when will they do capex? When they see capacity utilization bottoming out and get a fear that, so ROEs going to double digit are making this trigger for corporate capex much more ready to happen. And that's the good news. And hence this deleveraging which we spoke about is what is also played out here. So if you see the 2000 to 2010, there was a bottoming out, and then the leverage started as they built fresh capacities, and then they started reducing debt from 2016 onwards. And so this is now, there's not much more debt to repay now. So now onwards, they will again look at taking fresh debt. For what purpose? To finance their capex, right? So for that, the biggest support is the level of interest rates today. Thanks to RBI's reducing the repo and the reverse repo rates to record levels. Two, they're pumping in 30% of India's GDP in terms of liquidity into the market, means that loans, existing loans as well as new loans, both have seen more than 100 to 150 basis points drop in interest rates. So this means that today, if corporate India, thanks to their improving ROE and their improving credit rating, will borrow at very record low rates, so that temptation to commence new projects is probably at its highest, which is what brings us to the corporate capex cycle, where if you just look at it, right, projects under implementation are yet to witness a turnaround. So clearly capex, corporate capex is at a bottom. The uptick not yet seen in the projects under implementation. But the other way to look at it is as a gross fixed capital formation in the system. Even that is reflecting a continuous downturn. So clearly corporate capex cycle is at a low, right? And what has driven this low has been the fact that household capex, which is housing, buying houses and all of that, is the one which has contributed to the down cycle, right? If you look at it, corporation capex, the blue, has been more or less stable at 15 to 14% of GDP. Government sits around 3 to 4%. It is a housing cycle which is by cooling off. From a 16%, it has come down to 11%. And that's the pickup which we spoke about as the very first part of the haptic, right? Is which is going to drive the up cycle next of the capex cycle, right? So center is also from a governmental capex, so already up the ante. So if you see up to FY20, for the last 5 years, we were at 1.6 to 1.8% of GDP. But already in 2021, they put it up to 2.2, and this year's estimate takes it to 2.4. So government is going to support this push, but ultimately these orders for the government have to be fulfilled by the private sector. Where is the government spending this? It's largely spending in roads. Let's put roads, railways, and others. Railways has gone up small way, others has gone up small way, but it's the roads, if you see, same period comparison, April to August 2019, 2021, has seen a sharp uptick. So Mr. Gadkari obviously has been doing a very good job. And the road construction means that employment generation happens, cement demand goes up due to concretization of roads, and steel demand also goes up for the same reason, in addition to other stuff like sand and others. So clearly the roads are the path of the government in terms of generating a multiplier effect, right? And now we come to the private sector. Now, in the private sector, let's look, when will they do fresh capex? Is when capacity utilization starts rising and they are worried about future. So March 11 was the previous peak. 83% was Indian economy's overall average, and these are some of the big sectors there, all hovering between 80 to 90. Pre-COVID, as the economy had already gone to a downturn, it dropped to 73. Then post-COVID, it started recovering out of the first wave, but just before the second wave hit, it was at 76. And again, the second wave hit it, it is back down to 72. Now, what is this thing? Is that now from this period, right? If you see a demand pick up by 10%, then you will see 72 plus 7 go straight to 79. And one more year of that, right? So as long as the optimism that the demand is happening, then corporate capex for catering to their demand for the third year, when they will be short of capacity, they have to plan today and invest today, because it takes 2 to 3 years to build fresh capacities. So that's where you see that private capex announcements have started. So that's the way this thing works. First they announce it, then they go about searching for the right vendors and all of that. Then they place the orders, then they tie up the financing, then they execute the orders. So this cycle, as I said, we expect over the next 18 to 24 months to start playing out, right? And key sectors which are going to drive this are, first is steel, where from a 3 year, if you see last 3 years what they did, it's going to be more than double in terms of steel capex, because government infrastructure needs steel, private sector factories, as long as you need concrete, you need steel. So that's the one. The other part which is there along with steel is of course cement. And cement went through capex of downturn because nobody was creating fresh capacity, because the economy has already shown a V-shaped recovery. So cement and steel are the two key drivers that we expect. The third thing that we expect to drive is the recent launch of the PLI schemes by the government, which, as you may remember, is part of our targeting China plus one. Those companies which are manufacturing in China are looking to diversify out of China for various reasons, which I dealt with in my previous webinars. But government, to take advantage, has launched this PLI investment incentive scheme, and based on which, while that's ultimately meant to export compete with China, right? First, it needs the factories to be put up, right? So the PLI scheme will lead to capex for building those factories, and hence we expect the following uptick in PLI related capex to also help the capex recovery cycle, right? So, but this capex cycle is good to talk about. How about financing, right? So first we talked about the banks, because the banks' credit quality has improved, because interest rates are at bottom. First thing is corporates will say they can go and take bank loans. That's number one. Number two, from the government's financing perspective, government has launched a very innovative way to finance its capex, which is called the National Monetization Pipeline. So already 6 lakh crores of assets have been identified for this. So this is a way, without giving up ownership of the asset, the government is monetizing. So this is the second financing path that will come into play. The third financing path is the banking path I talked about. Sorry, this is the second. right? Which, if you see the previous decade, was at 23% industrial credit growth. From 2017 onwards, it's at 2.2%, right? So the scope for it to go up 10x is strong. So this naturally bank credit will be a key part of the whole financing picture for capex. The third one, which starts with the PLI but is not limited to the PLI, is the FDI flows. Because foreigners who come to use India as a manufacturing base will bring in that capital, which is permanent capital, to finance that capex. So if you see this chart here, already the government's programs in terms of liberalizing FDI, reducing corporate tax rates, improving our ease of doing business, all of that has resulted in India being the second after China, way above the rest of the emerging countries in receipt of FDI flows, right? So this is China plus one playing out, and this will finance our capex story. In fact, last year we got $81.5 billion in thing, which is almost 3% of India's GDP, right? And 25% YOY increase in the FDI. So clearly the third leg. So bank finance is the first leg, government monetizing its assets is the second leg, and FDI will be the third leg. The fourth leg we shouldn't forget is the capital markets. That is the domestic equity markets. Existing corporate companies will come and do rights issues and follow on public officers, and the capital markets will also support this corporate cycle of capex, right? So as a result, we expect private corporate capex to go from 9% of GDP to 14% of GDP by 2026. So this is the big story which is going to drive the Indian corporate earnings. So I put back this slide just for a minute so that you can get a quick glimpse of this whole haptic that we spoke about, right? What we went through in detail. Those are the summary points. And as I told you, from 2020 to 21, you're seeing that lots of this cycle is moving from the bottoming phase to the rising phase. And hence the situation is ripe for a multi-year GDP, high single-digit GDP growth for our country, which from the haptic cycle should lead to an increase in our GDP by $1.4 trillion in that 2020 to 25 period. And what this means is absolute GDP, obviously US, China, and the Eurozone contribute the most, but the next in line are India and Japan, who will contribute 5% and 4% of the incremental value add in GDP in the world, right? And so this $1.5 trillion of growth will take us, when it happens, to a $4.1 trillion GDP by 2025. Yes, it's not the 5 trillion that we spoke about a few years ago, but the pandemic has obviously altered the dynamic. But even at 4.1 trillion, the good news is that we will be overtaking our earlier rulers, the Great Britain, who will be only at 3.8, and India should leap over them with this 4.1 GDP for the become the third largest GDP country in the world, right? So to summarize it, finally, how does this affect our portfolio and all of that? So obviously the first line is a very general line, but second one is the important thing is we got to keep this growth focus and look at the value based on that growth, right? So our portfolios are positioned for one, investment cycle resurgence, and two, the consumption boom, which we expect from the post the second wave and the festive season playing out, right? So this domestic growth story, how are we going to play it? We're going to use quality financials, both banks as well as NBFCs of high quality, consumer discretionary as a key piece, building materials for the housing, auto as well as industrials as our play. Global recovery, when it happens, as you talked about a synchronous recovery, we'll play it through metals, through specialty chemicals, to auto ancillaries and IT services, the last three of them being export-oriented sectors, right? So apart from this, overall, we have a very strong outlook on IT because we believe that across the cap curve, the fact that the world is going through this migration from hard disk hardware to hosting everything on the cloud, this cloud migration needs a lot of technology change in the user companies, plus this transformation to digital, which got a big boost from the pandemic itself, right? Both of these are going to benefit IT across the value curve, across the cap curve. So that will be a continuous strong share of our portfolio. But the large macro trade of huge liquidity coming and taking up everything has happened. Today, we believe that stock selection is what is going to drive returns in the years forward. And finally, we think that given the domestic economic environments strong improvement expected, we think rising participation of mid and small cap is going to be a key foundation of that story, right? Thank you very much. With that, I end my presentation.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.